Stocks took a breather today despite cooler inflation numbers that help boost hope that the Fed may cut rates here as early as September, keeping the door open for a couple hikes by the end of the year. The S&P opened strong on that CPI data, but then faded late, especially with news coming out of the Middle East. Volatility ticked up higher. Sector leadership narrowed sharply, as you'll see on the Market Outlook post. It was pretty much one sector was the only sector that was up today, which was energy, which surged on rising oil prices, while technology stocks in general, whether it's discretionary, communication services, materials included actually today, all lagged behind. In today's market outlook, we'll break down what today's macro signals mean, how the technical picture is shifting, and what this rotation says about where the big institutional money may be headed going forward. So let's go ahead and get started. Today is Wednesday, June the 11th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. If you're watching this or you're checking out our blog, remember you can sign up for our email newsletter over here on the right with this form. You can sign up for our new foundation tier up here at the top by clicking on join now. You can also see there's a button as you scroll down here to click on to see that. Remember, for the rest of this week, the full version of the video will be free. But starting next Monday, it won't be, right? You'll only see a 5-minute version here. The full version will be behind on a separate page. This link will take you to there, but as of now, it's taking you to the place where you can sign up. So you can join our foundation tier. Again, $29 per month, which works out to less than $1.40 per video. Or you can sign up for the yearly plan where you get 2 months for free, right? So that's a benefit for you there. Click on that link and that will take you to the sign up page. Remember, if you sign up this week, I'll be sending out over the weekend a sector rotation video that's only going to be for the founding members of our foundation tier vids, as well as all of our premium subscribers as well. But it'll be for all the founding members of anybody who subscribes here by the end of the week. Let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we stayed above 6,000, even though we had a decline today. We went from 60.38 down to 60, so about 16-point decline. Not that big of a deal. Like I said, stayed above 6,000 at 60.22. The intermediate line stayed above the 80th percentile. Very strong. Like again, that's not going to change until you get a big sharp drop like this over here in short-term sentiment. And obviously, like the near-term line fell and the momentum line fell, but not, the momentum line's got to drop all the way down to extreme levels. The near-term line's got to drop all the way down into the reversal zone, close to the extreme levels. So that's not the case today. In fact, we've had a couple of near-term declines on this current near-term rally that didn't actually get to bearish territory. So, which means we're still on the same near-term rally despite those little dips. And as of right now, you can almost argue that this is probably still another one of those. I mean, the momentum line's down, but it's not oversold. So there's no buy the dip signal like we had over here, the bullish intermediate confirmation signal. So we're not getting that. We're still 3%. So we're still more than 2.5% above the moving average. We talked about that yesterday or the day before. When you've been above the moving average by more than 2.5%, the next stage usually is just to kind of hover around there. Between 2.5 and, being positive and 2.5, and just kind of hover in this area. And so you can see kind of how it hovers around 2.5% when you're strongly bullish, just kind of stays in that area there. So that's kind of the next stage when you've been, like in this case, well over the 5% mark. So that's a grind. That would be a little bit of a grind to the upside, but that's okay, right? The market sentiment line, which is the long-term trend, is rising. Showing strong bullish trends, so everything's looking good there. The Nasdaq 100 would look exactly the same, right? It's we're 4% above the moving average, but everything else looks exactly the same. We're still in the same near-term rally. We've had a couple pullbacks, momentum lines down, but not oversold, so there's no buy the dip signal here. But it doesn't necessarily mean that we're going to have another down day tomorrow, right? I would assume actually that we'll probably end up with a little bit more of an update tomorrow, considering how the market has reacted to down days here recently. Obviously, anything can happen, but just based off of how we've responded to down days recently, I would expect that we'll bounce back up tomorrow here pretty quickly and keep the near-term line up higher. You can see the Dow looks almost exactly the same, momentum line, near-term line down, but not down significantly. And then finally, your Russell 2000 was down today too. This one's a little different because the ranges have been so small, and this range was almost average. The momentum line did dip down to extreme lows. So, and the near-term line dropped out of bullish territory. So it's not bearish. It didn't cross into bearish territory. This is technically day one of the near-term line crossing below 60. Because you remember when we look for near-term changes from bullish to bearish, it's obviously it works the other way around too. But in this case, when we're going from bullish to bearish, we're looking for just any signs that change might go from, in this case, pretty strongly bullish to pretty strongly bearish. Like you're looking for some kind of trend change, right? And so one of the things you look for is, okay, you got 2 days to go from being above 60 to being below 20. And on the first day, it's ideal that you break multiple lines. In this case, we've only broken 60. So that's a positive, I think. But on the flip side, the other thing that we look for is that momentum line is lower than the near-term line. In this case, it's in the reversal zone. In this case, it's actually extremely low. So that's actually the downside. So on one hand, where it actually looks pretty good that the near-term line didn't drop very far, on the day it did cross 60. On the other hand, the momentum line is so extreme that it suggests there's a good chance the near-term line does drop tomorrow down to the downside. So while everything else from a large cap index looks pretty good, this doesn't look bearish at all and doesn't look like it's even close to being bearish. On the small cap side of things, it's a little bit of a concern. But you can see the momentum line's pretty volatile for the small cap. This is the higher beta index. It tends to be pretty volatile. So I would put less stock into it on the Russell than I would on the S&P 500, where it is a little bit bigger of a deal. So despite that, I would still expect, in this case, intermediate confirmation signal, right? It's a little bit more oversold than we like, but it still is in the reversal zone. So it's still oversold combined with a strong bullish posture. Again, and a good chance that we bounce up. Now, we're not going to start a new near-term rally because we've been on one for a couple of weeks now. So we're getting towards the end of one. But, I think there might be a little bit more juice left in it before we ultimately get the near-term line down into bearish territory again and start a new rally up to the upside. All right, let's take a look at the weekly chart here. And you'll notice, again, the nice, good bullish candle. Like we talked about, we're still trading easily above it. Well, I guess we wouldn't say easily. We're still trading above it at 60.22. The Hakinyasha close right now is at 60.20. Remember, the Hakinyasha close is the average of the regular candles open, high, low, and close. So you take the average of those four values and you get the Hakinyasha close, which is this body up here. The open, remember, is the midpoint of the previous body. We are above the 10-week moving average. It's rising. It's rising above the 40 weeks. So you've got a rising PPO down here at the bottom. And so far this week, the size of the candle is above its average, barely. It's barely above it. That's positive. But, if we finish the week at 60.22 or even less, then we're most likely going to end up with a transition candle next week. And you remember, transition candles don't necessarily mean they're reversal candles unless it is a reverse, unless that in this case, a transition candle coincides with a very bearish, or I wouldn't say very bearish, but a significantly bearish regular candle, so that we kind of check that out here next week. We never did get the green arrow on the MACD, so we still haven't gotten 3 green arrows in the S&P or the NASDAQ. In fact, the MACD histogram has turned red again, so it's moving back down slightly. It's not very much of a move. The S&P, the Dow, and the Russell do have 3 green arrows still. The Dow for 2 days in a row now, the Russell for 4 days in a row. So we're still okay. All right, we're still on a positive run. Obviously, the moving averages are green because we're rising up to the upside, and the indexes are all above their respective rising moving averages. You can see we are still above the 8-day. The MACD is below its moving average, so we're in this convergence mode. You can also see that, with the higher highs we're getting a lot of lower highs on different oscillators, the stochastics included. So it's still above its average though, but even with a little bit of a decline, it's still above its average. But you can see how we're losing momentum, right? Like we're just kind of like we had some strong momentum here, and now we're still rising, but not nearly with the momentum as we head into resistance at the top of the value area, and again the 52-week highs that the index has had. If I take a look at the directional movement index, again, we're still above 25. We're still below 20 in the negative. So the ADX is slowly moving higher. It moves up faster when the positive, or when, depending on the trend, right? Because the ADX down here, the black line, doesn't care about what trend it's on. So in this case, we're on a bullish trend because the positive indicator is above the negative. So it moves up faster, as you can see here, when the positive is above 30 and the negative is below 20. That's when you get a really strong run, and we eventually got the shading. And we'll actually get light green shading tomorrow because we are above 20. Assuming we stay above 20, we'll get that tomorrow. But it's really going up slow. It's not a strong trend at all right now on the S&P 500. If I take a look at some of these other, like the RSI and the CCI, they're still showing bullish levels, above 60 on the RSI, still above 100 on the CCI, so that's good, right? Those are still very strongly bullish levels. The Ichimoku cloud, you can see we're still easily above the cloud. The cloud's huge. We dropped today, but we stayed above the 8-day average, so there's no concern there. The trend's still very mature. I mean, to break a mature move trend, you got to break below the blue line, which is the midpoint of the 26-day range. And obviously, we're nowhere near that, right? So the rate of change is clearly positive, though it's starting to come down a little bit. This is kind of another sign. This is that red line is plotted down here. It's the actual rate of change over 26 days. And I mean, it's still very strong. If you look back over the course, at least of the past year, like a 6.75% or 6.5% return is actually still very high, relatively speaking. So, now granted, it's not as high as it was. And there's been other instances over the past 5 years that we've had higher than that over 26 days. But this is, I mean, you would still be in a very high percentile here for that. So we're doing okay. I think we're doing okay on the rate of change, even if we're starting to slow down a little bit. So that's what you see. That slowdown is what you see here, where the gap between the price 26 days ago and the current price, which is the red line plotted back 26 days, that gap is shrinking. But still, it's hard to break a mature trend. Once it does, then you're usually in intermediate decline. So, you can stay mature for a very, very long time here. And it can get very mature. Like it can continue to move higher as momentum builds on itself. And you're outside the Bollinger Bands. Like, now we're not outside the bands today. We stayed inside a little bit. And we also, after closing outside the Keltner channel yesterday, closed back below that too. So the momentum turned back south just by a smidge today, and the bands themselves, even though they look like they're about to cross out, like on just the very verge of crossing out, we still have the red dots down here, which means the bands are still inside. So very, very, very narrow bandwidth considering, where that bandwidth has been here lately. A big drop in the bandwidth in a very short amount of time. Looking at the intraday chart, we did get a new high today. That's good. That resets the clock for 6 days to get the green line below 70. Until that happens, we don't really worry about intermediate declines forming. So that's good. I mean, we are high. We're above the value area for the 4 weeks, but there's nothing wrong with that. We closed above last week's high, despite the weakness. We ended up closing above last week's high. But you notice we did not close above yesterday's high, which is this dotted green line here. So we got a higher high, we got a slightly higher low, but more of a neutral combination than what we see. So it looks like, the technicals are kind of like slowing. Like as some days you have good days like yesterday, and most of the other days are going to be like today, right? When you're grinding high, you're going to get a lot of days like today where it just doesn't seem like we're doing much of anything, even if we're up 0.3%. That would be the case going forward. I showed you the range was still relatively small, higher than where it's been at almost 6 points, but again, the relative ATR is still dropping like a rock there. When I look at the volatility index, it's still in the sweet spot, right? It's not too hot, it's not too cold, it is just right, right? So it's not above 105, it's not below 80. That's too hot or too cold. It's like right in the sweet spot for risk appetite. It's the VVIX jumped up today, and this is a little bit of a concern. Like, that's a big drop in the correlation. We saw last time there was a little bit of jump. There typically is a jump in volatility when the correlation drops, and the correlation jumped. Like, the VVIX jumped up to almost 100 again, even if the VIX itself jumped, but not by very much, right? It didn't jump up very much there. So, like, we're still in the sweet spot, but a little bit of a concern on the volatility index as to, potential period of volatility coming up here sooner rather than later. So here's let's go to, excuse me, sorry about that. Let's go to the correlation here of the VIX. All right, so you can see, the correlation obviously negative with the S&P 500, but we're kind of getting into a period here, going through the 4th of July holiday into the end of July, of falling volatility from a historical standpoint. This has generally been a period of falling volatility since mid-March to now, and it looks like after what can be a little bit of a pop this time of year, short-term pop, we're not done with this falling, at least according to seasonal trends. And this is where volatility, this is where people start to, get the idea of sell in May and go away, is because the volatility, while there is some upswings here in May and early June, really the upswing occurs from late July through August, September, and into the bulk of October before, volatility starts coming back down again. So this is the sell in May and go away that people are worried about, right? The trend that people are worried about there. If you take a look at what's driving the price action, here's what happened today. Commodities jumped up big today, and a lot of that came in the afternoon when the news came out that, there might be pushing some ambassadors and embassy officials from Iraq out. So some tensions going on in the Middle East, and that pushed crude oil prices higher, pushed commodity prices higher. Gold obviously goes up when there's geopolitical issues like that. And the dollar was down the commodities were up today already, as it was up almost 1% before that news came out, because the dollar was down quite a bit. And that didn't help gold so much, but it really helped commodity prices and emerging markets in general. So, if I take a look at what's going on in like the charts here for commodities, you can see, look at that break up to the 200-day moving average. Now, we have had a couple runs to the 200-day and beyond over the past year, and none of them took. Right? Not a single one of them took. At some point in time, it will, but really over the last year plus, there's been multiple attempts to get above the 200-day and get going to the upside, and they've all failed. And now you can see, we're at the point of control for the past 5 years, which also happens to be about the point of control for the past year. So, there is some very strong resistance here on commodities, so it's not going to be easy to push through. It doesn't mean it can't push through. That it just means that if it does push through, then there's something going on, right? That's a pretty good move. Same thing with crude oil here. Crude oil, look at the PPO; it's very high as we head into a very strong resistance at the 200-day moving average and the point of control. So you wonder how much legs that has left in it. When you look at the dollar index, it did drop back down. Today, you can see it's still below all these moving averages. The MACD and stochastics are still at bearish levels, even if they're not necessarily falling anymore. They're still at bearish levels there. And then the other big thing that happened today was the 10-year yield. You can see the 10-year yield dropped quite a bit. It opened up higher despite the softer inflation data, but it dropped quite a bit. And so, remember that's an impact. The inflation data has an impact on these interest rate cut expectations. So if you take a look at that here, take a look at the interest rate cut expectations here, and you can see for September, we're actually moving up a little bit, right? So we had a 60% chance of a cut, maybe 62% chance of a cut. Now we have about a 73% chance of a cut in September. So that's ramped up a little bit here. The December was priced in for 2 cuts previously. So right now we're at a 95% chance of 1. We're at a roughly 70% chance of 2, and then it drops all the way down to 30% chance for a third one by the end of the year. So there still is this idea that they are going to cut rates, and it's going to start in September. It doesn't mean it will, because remember just 2 months ago we had a 100% chance of a cut, according to the futures market, for next week's FOMC meeting. And we're obviously not going to get that cut now. I mean, there's not even an inkling of hope for a cut there. We're at 9. I mean, I guess there's a 0.2% chance that we might go up, but there's no chance at all that we're going to cut as of now. I mean, just a month ago it was at 17% chance of a cut, but now it's pretty much 0% chance. So we're at a 100% chance that the Fed won't do anything, and that makes sense. It is they still have to follow their mandate, and their mandate isn't necessarily the only things that are telling them to cut rates are the administration, number one, and just the concern for risk appetite. But that's not like there's plenty of risk appetite now, so it's not even necessarily a concern. Breadth is always an important topic, as I showed you before. Sorry about that. Not that one. Not that one either. I was looking up some Zweig breadth thrust stuff. The breadth, remember, we are watching closely this index, and it did not go up today. We need a breakout here above 300 on the number stocks above the 200 days, so we can get this ratio going up above its average, and that still hasn't happened yet. So we're still not necessarily getting what we want to see from the skew, right? Where's my new highs and new lows? Here it is. So we're at 200 on net new highs and lows. So that's not bad, but we're not getting the full on. We've had a lot of stocks above their 50-day average. Got above 300, almost getting above 400, which, as you can see, is an extreme for this particular index. 90% is actually even more of extreme. So it can get to 90%. And that typically leads to some volatility, if not correction, but most likely at least volatility. So that's, this has been great, and the average is already pretty high. But what we're not seeing is those same stocks getting also above their 200-day. We're about 50-50, a little bit more than not, but we're not into bullish territory, which is above 300, and that's where you really establish a bullish trend going forward with that positioning. Let's take a look at the sector moves. So I shared this on the market forecast post. The sector comparison chart's odd today. You can see, technology has been the big winner over the last little bit. But if you take a look at, the sector rotation, again, most everything was kind of hovering around 0, plus or minus a little bit. But when we got the news out of the Middle East, XLE jumped up to 1.5%. Everything else fell. Remember, rising yields, rising commodity prices, and a rising dollar is that three-headed monster that we are fighting in 2022. But remember, when XLE outperforms, that is not what we want to see from a market standpoint, right? We want to see XLK outperform. That's our big winner, right? That's the one that we want to push to the upside. Energy, which is looking good here, and you can see the relative strength chart for energy is improving, even if it's not quite all the way there yet. Here, let's go to, let's see here. This one, we'll do XLE relative to SPY. See, it's not positively correlated, and typically is not. If I change this out to 5 years, typically this indicator is not correlated positively. So if it's outperforming, that generally means that something's wrong. It can go up, right? It just won't go up as much when we're bullish. But if it's going down less than everything is going up, which is what would make this ratio go higher, that's we don't want to see XLE outperform, right? We just don't want to see that and keep the market going strong as it is, right? This is underperformance by XLE is what makes the bull market, as you can see, for the past 2+ years. So we'll see if energy starts to rebound, and this is more than a one and done. I mean, we are clearly above the 30-day average, so we have crossed through some important levels. here when you look at it from this perspective. But you can see we're still below the 200. So we'll see kind of where if we keep going up, what we do at the 50 and at the 200-day, which is, they're very strong lines that most everybody who's trading these has some inkling of those long-term moving averages, because you just hear about them so much. This brings us to our trade idea, which is actually in the energy sector, is on Occidental Petroleum. Let's take a look at the charts for Occidental, XY. Dark green shading and a green line. Nice little breakout up here. We can get rid of these lines, actually. We're not, and those are from old iron condor. We did get a bull put spread. We bounced off of it. We're going up to new highs. The intermediate line's rising. The near-term line's up in the reversal zone, helping push it up higher. Market sentiment line now is rising. So things are looking positive. They haven't been so positive, but it seems like, as sideways as we've been, we're starting to get some action here. It's not as big of a bullish candle as we had, but it's pretty strong, right? The PPO is rising now from pretty low levels, relatively speaking, to the past 3 years. Looking at the 3 green arrow chart, obviously you have 3 green arrows. If you look at the moving averages, we're above. The 8 and 17 day have been above the 30 after that little bull tag, but now we've crossed above the 50, and we're making our way up towards the 200 in the point of control. So there's not a whole lot of upside potential here until you meet resistance, but there is some, as we generally start to fill in that gap up to the 200-day moving average. So if you take a look at some of these other oscillators, and they're all showing positive levels, bullish levels. We're above 30 on the positive indicator, below 20 on the negative indicator, so your ADX is rising pretty quickly there. If you look at the RSI and the CCI, they're both at bullish levels, well above 60 on the RSI and well above 100 on the CCI. And you can see the weekly CCI is not quite above 100 yet. It's been below 100 this whole time. The closest it came to getting above 100 was over here at 99. So we're not quite above 100 yet. We're not quite above 50 yet on the weekly RSI, but you can see just how close we're getting and looking much better. When you look at the Ichimoku cloud, and the trend strength indicators, a new trend develops. So we're above 50 now. We're above 1 on the trend quality. We're above the cloud. The rate of change is positive. The cloud's almost turning pink there as the green line is crossing above the blue. So things are looking much, much better for the cloud. And then when you look at the Bollinger Bands and the Keltner channel, and you can see, we are above the upper band, and we are the bands themselves have moved outside of the Keltner channels, and we have closed outside both the upper band and the upper Keltner channel. So these are very, very good signs for the markets here, or at least for Occidental here. And so what I decided to do was do a bullish trade, obviously, and we looked at doing a long call spread, not too aggressive, right? Because there's not one in the low 20s that's more aggressive. So we went to the close to the mid 30s. Which is, there's probably the best, only option we got. But the nice thing about selling that and buying in this case, happens to be at the money strike, it still gives us about a 1.5 to 1 risk to reward ratio. So again, it's kind of like, and pretty higher probability too. So it's kind of like, again, a bull put spread. It's more directional bull put spread where I'm putting less risk on at the time and for twice the normal reward. So it's kind of kind of a safer long vertical spread that behaves more like a short vertical in terms of, we're just hoping for a move up. It still has to move up, but it doesn't have to move up as much. It only has to get to 47.5, which is, easily below this, where this significant resistance is, which happens to be above the 200-day moving average. And it would have to get there, obviously, by July expiration over here. So that's our trade idea for today. Well, that does it for today. You've heard from me now. I want to hear from you. You can reply to the Market Outlook tweet that was posted out there today. You can, it's also in the bottom, excuse me, of today's Market Outlook blog post. You can also comment on the Market Outlook blog post down at the bottom. Scroll all the way down to the bottom there. You can leave a comment there. Let's see what you got to say about today's Market Outlook. Remember, you can also sign up for our foundation tier for the rest of this week, our new foundation tier. So either the monthly plan or the yearly plan. You can get a link to that as well in the description of this YouTube video, as well as on our site. Send us an email if you have any more questions about that at support@marketscholars.com. Remember to subscribe, like, and comment our YouTube video. Follow and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you in class tomorrow.